Most people think market crashes start with panic. They don't. They start with confidence. The most dangerous phase of any bull market isn't fear. It's comfort. It's when investors stop asking, what could go wrong, and start saying, this time is different. That sentence alone has quietly destroyed more wealth than any recession, war, or scandal. Sir John Templeton, one of the most successful investors in history, called it the 4 most expensive words in the English language. And he wasn't being dramatic, because nothing drains a portfolio faster than optimism wearing a lab coat. The illusion of progress. Every generation believes it's smarter than the last. We have better data, better technology, better tools, so we convince ourselves that past warnings don't apply anymore. But markets don't run on technology, they run on human behavior, fear, greed, comfort, denial. And those things never update. A trader who saw through the noise, Jesse Livermore, understood this better than almost anyone. He made and lost multiple fortunes, not because he chased trends, but because he studied people. Livermore believed markets moved in patterns because investors move in patterns. He once said that nothing truly changes on Wall Street because speculation itself is ancient. Different names, different charts, same emotions. And there's a forgotten chapter of market history that proves his point better than any chart ever could. America's confidence era. To understand it, you have to step into America in the late 1960s. The country was overflowing with confidence. The U.S. had dominated the post-war economy. Factories were booming, the middle class was expanding, suburbs were multiplying at record speed. For nearly 2 decades, the stock market had done little more than go up. A generation of investors had never seen a real collapse. Recessions felt theoretical, risk felt outdated. When hold forever became gospel, that environment gave rise to a powerful new investing philosophy. Instead of analyzing cycles, people began chasing certainty. The idea was simple. Some companies are so dominant, so essential, so embedded in everyday life, that you never need to sell them. These weren't speculative bets. They were considered permanent winners. Buying them was called owning the future. Selling them was seen as irrational. The Nifty 50 mindset, a group of elite companies came to represent this belief. Coca-Cola, McDonald's, Xerox, Polaroid, American Express. These weren't startups. They were icons. People didn't ask what price they were paying, they asked how many shares they could get. Valuation became irrelevant. Confidence replaced caution. When price stops mattering at the time, the broader stock market traded at reasonable levels. But these can't lose. Companies were treated differently. Their prices climbed far beyond historical norms. Not because earnings exploded, but because expectations did. Some traded at levels that assumed perfect growth for decades. And investors didn't see risk, they saw safety. Concentration risk no one talked about. As money flooded into these stocks, something subtle happened. The market became top-heavy. A handful of companies began to dominate the entire index. Owning the market meant owning them. If they succeeded, everything worked. If they stumbled, everything broke. But no one wanted to imagine that. Reality doesn't care about stories. Then the environment changed. Oil prices surged. Inflation spiked. Unemployment climbed. Economic pressure mounted. And the market cracked. Not gently, violently. The decline wasn't selective. The most popular stocks fell the hardest. Some lost more than half their value, others collapsed nearly 90%. These weren't failing businesses. They were businesses priced for perfection, colliding with reality. The longest part waiting. Here's the part that rarely gets mentioned. The damage wasn't fast. There was no instant rebound, no heroic comeback. It took nearly a decade for the market to recover. Investors weren't wiped out, they were trapped, holding companies they still believed in, waiting for prices they paid years earlier. That's what overvaluation does. It doesn't always bankrupt you, it steals your time. Why this story matters today. If this feels familiar, you're not imagining it. Today's market has a similar structure, just with better graphics. A small group of massive companies dominates the indexes. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. Together they represent an enormous share of market value. And once again, investors speak in absolutes. These companies will always win. They're too big to fail. They run the world. That confidence sounds familiar because it is. Great businesses safe investments. This is where people get uncomfortable. A company can be revolutionary and still be overpriced. Innovation doesn't eliminate risk. Dominance doesn't guarantee returns. When expectations get stretched too far, even good news isn't enough. Markets don't punish bad companies, they punish unrealistic beliefs. History doesn't warn, it whispers. No two eras are identical. But when patterns rhyme, ignoring them is expensive. The danger isn't collapse tomorrow. The danger is assuming nothing can go wrong, because that's exactly how every major market disappointment begins. Final thought, the riskiest investments don't feel risky when you buy them. They feel obvious, they feel intelligent, they feel inevitable. But the moment everyone agrees there's only one decision to make, that's when caution matters most, because markets don't reward certainty, they reward discipline.